Good morning, traders and investors. My name is Roger Scott, and I'm still the senior strategist for Wealth Press. It's Wednesday. It's December 7th. It's about 8:14 in the morning. The market's going to open up in about an hour and 16 minutes. And boy, oh boy, we're already down 100 points on the Dow, over 100 points on the NASDAQ, and the S&P is meeting us in between. Now, I hate to be the bearer of bad news. I hate to tell you, I hate to say I told you so. But I did. I told you that, here, let me just point this out. Remember I told you that rally we had last week, that all those emails I got, that 700-point rise? Remember I told you it would all be falling apart? It didn't take very long. It literally took 1, 2, 3, 4 days, and now we're below this channel. Now, I don't know if you guys follow my videos or not, but if you do, then you know that I said if we break this channel, then we are going to the 200-day moving average. And I also told you, I was saying this back here, by the way. I wasn't saying this down here. And if we break this channel, we're going to go to the 200-day moving average, then we're going to break the 200-day moving average, and then we're going to go down. And if you look at the SPY, we stayed above that 200-day moving average for 1.5 sessions, okay? Before breaking down. We're already below the 200-day moving average. We're already heading towards the 50-day moving average. And if we break the low, which we already did this morning, yesterday's low was 391.64. We're at, let's see, 391. We're already at 391.31 right now, right here. So yeah, the low right here is 391.64, as you could see right here. When I point this clicker, 390, here, let me just click on this, 391.64, but we're right now 391.51, so we're already below that level. And as I said, if we break that level, we are going to go to the 50-day moving average. Now, the bond market still hasn't given up the ghost. It's still rising a little bit, but I'm telling you, the bond market is going to start increasing its yield. Interest rates are not going down, they're going up. And this overbought level right here that we're seeing right here is telling me that this market is going to cool off, which is why we're short the bonds. So I'm expecting more downside pressure on bonds, which will put more pressure on stock, especially technology stocks, and the broad stock market. In terms of news, we've got petroleum status report, productivity, and consumer credit. Tomorrow we've got jobless claim, and then we've got PPI, which is a huge, huge report, and then Fed talks again and lets us know how the rate will be. And then we got the CPI next week, which is huge, huge week. Huge week ahead. Now, as I mentioned to you guys last week, I said that this level, S&P was at 90th percentile. It's at 78, and this is at 56. It huffed, it puffed. Look at all of these levels, how the weakness in all of these sectors is finally coming through. You're not seeing 80th percentile here, are you? 41, 54, 19, 36, 50. That's a lot of vulnerability for the stock market. And as you will see here, and I hate to be right about this, but I've been just dead right on this. Look, we're already back in the base. Let me just change this, give you guys a little, in case you haven't been watching me every day, so I'll just kind of give you an update. What I've been talking about is these levels being surpassing the levels we saw in, here, let me go to a 20-year chart, surpassing the levels that we saw in 2020. That was the COVID bounce, and now we're back down. And anytime we go up here and we come back down, especially this fast, I'm telling you, this is going to come down, and our momentum levels are going to break down like there's no tomorrow. So this was 90% last week. Now it's 78%. The Dow was 95% now. It's 85%. I'll bet you it's going to go down all the way to 50. And look, it's already inside the area. It's not out there anymore. And the last time we saw these levels on the Dow was in 2016, and we never saw levels this high. Never. So I'm not kidding. I'm not kidding when I tell you that this market is set to go down. Now, volatility levels. Now, I read a report that volatility levels are at the highest level they've been in a few days or since November something. Well, I'm going to tell you what. Let's see here, November 28th. Yeah, that's the highest they've been in a couple of weeks now. So I think the volatility is going to go higher, and I think it's going to go all the way back up to the 30, 32 level. But I'm not expecting volatility levels to cool off at all. Now, let's talk a little bit about pre-market and what we can expect and what's driving the market right now. Before we do, I thought this would be kind of cool. I'm doing this every morning. I'm giving you the stocks that are coming out with earnings today. So we got Campbell's Soup. That's a stock that I watch very, very carefully. And I'm not as interested in what their earnings are. I'm really interested in what the forward-looking statements are because this will impact other consumer staples. And consumer staples is a very attractive and defensive sector right now, which I love, love, love. You got GameStop. People are talking about a takeover rumor, Elon Musk or Amazon. It's just nonsense. This company's worthless. I mean, they really are worthless. You got Copa Software. This will impact the infotech sector. You got a bookseller, John Wiley and Sons. Does anybody buy books anymore? And then you got Lovesac, the online furniture company that I have gotten increasingly bearish on as of late. Matter of fact, it'll be very interesting to see how they do. I would be very doubtful to see if Lovesac came out with better than expected numbers, and they're already down 7% pre-open. Ouch! That was one of the stocks on my short list last week in my VIP room. I'm not sure if you guys know that. If you guys got in on this, give me some love. Send me some love letters. Support at marketgeeks.com. I've been very, very bearish lately. So a few things there. And I thought it would be a good idea to give you that information before the opening bell so you guys can kind of see what's happening with the market. But let's go back to my pre-opening briefing. U.S. benchmark indices finished regular session in the red. Market participants fretted over Federal Reserve increase and further talks of an oncoming recession. Now, folks, when you hear talk of an oncoming recession, it's not a good time to look at bond prices to go up. They go down, which yield goes up, higher interest rates. 3 major U.S. stock indices were weighted down by oil and gas, tech, and consumer services. Kind of mixed, not really good. And I'm nervous about energies, but not nearly as nervous as I am about other sectors. Bank of America CEO told investors that the bank's research, they spent billions in research, showed 3 quarters of mild negative growth next year. Remember what I told you guys? We're not going to see any light at the end of the tunnel till the second half of 2023. Then showed 3 quarters. Summer of 2023, we're just 1 quarter apart. At the same time, Jamie Dimon, very smart man, said inflation would erode consumer spending power and cause a mild or hard recession that people worry about. These guys are smart. More importantly, they have data. They have a lot of data. They have data that you and I could dream of having. And real-time data. Futures. Meanwhile, U.S. futures are predicting 77% chance of a rate hike of 50 basis point and 23 now of a 0.75. And I predict that this 23 number will continue moving higher if the stock market continues moving lower and if the PPI and the CPI does not tame investors' expectations that interest rates are, in fact, going to go only 0.50. And I don't know why people are getting so excited about 0.50. It's not like interest rates are going down. They're only going up twice instead of 3 times. It's like somebody telling you they're going to cut 2 legs, and then they're going to tell you, oh, we're only going to cut 1, and people get really excited about it. I mean, you're still going to get a leg cut off, right? Today, all eyes are focused on the non-farm productivity reports. U.S. labor preliminary data is coming out. Crude oil inventory data will be reported today as well. That'll be very important. Economists estimate the figure to be at negative 3.305 million compared to last week's value of negative 12.58 million. At the same time, analysts at Goldman Sachs expect European stocks to have a tough start to 2023, which means we're probably not going to have that Christmas rally that a lot of people are expecting, falling in the first half before recovering in the second. That's exactly what I'm expecting for the U.S. stock market. More downside first half of 2023 and then upside second half of 2023. We expect 2023 to prove tougher after the resilience in earnings this year. What can I say? China today closed lower as concerns over a global recession and interest rate hikes by the Federal Reserve eroded positive sentiment. I used the word positive, but eroded sentiment. However, the relaxation of some anti-COVID curbs in China helped limit losses. Chinese government announced a further scaling back of COVID-related curbs on Wednesday, which is positive, but orders from U.S., I think, or around the world in China are down 40%. I don't know if you guys know this or not. For parts, 40%. It was a CNBC article. I was showing it to people in my VIP room the other day, actually. 40%. Actually, let me see if I could find this. This is an interesting article. I think you guys will will really like to see it. Let me just kind of show it to you so you guys see what I'm talking about. Here we go. There we go, right here. Look at this. U.S. manufacturing orders from China down 40% in unrelenting demand collapse. 40%. Now, they're talking about logistic companies and shipping, but how do you think this impacts the rest of the market? 40%. That's huge. That's not 5%, 40%. So when I say this market is in deep doo-doo, I really, really mean it. This is not a market that's good right now for long-term buy and hold, not even close. Now, as I showed you, volatility right now is set to go higher, not lower, set to go higher. If you look at sectors, if you look at the broad sectors, which we'll look at right now, you will see that only 60% of stocks trading above $2 are now trading above the 50-day moving average. Now, I wanted you guys to see that, and I showed this chart to you a little while back when we were up at about the 75th percentile, and I told you that the market is very vulnerable right now, and this is going to start cooling off, and it is. And I believe it's just getting started. How do I know that? Well, let me tell you how I know that. Because look at 20-day breakouts. 44, nothing really crazy. Look at 20-day breakdowns. 130. Folks, you'll need to see this number near between 400 and 600 before we wash out. So probably closer to 600. So we are just getting started. This energy sector, I don't think has more downside, but a lot do. As a matter of fact, let's go through some sectors. So financials, I think financials are going to go down all the way to the 33 level. I think energies are becoming overdone. Matter of fact, if you start looking at energies, you will see, let me go to my template here. You will see that energies are now a little getting closer to overdone. I think we may go down to this support level right here, not resistance, but support near the 82. But I think we're going to bottom out here and start coming back up. Now, remember, folks, this is not the first time energy has gone down. Look, it went down before and it went up. It went down before and when it went up. And I also believe we're going to see a very, very similar environment when we're going to get oversold territory, and then we're going to bounce back really hard. So don't give up on the energy sector just yet, and keep your eye for these oversold levels. Now, as I said, energy may be a little more downside. Utilities are holding up really well because utilities are pretty good inflationary hedge. Industrial stocks, you got to be really cautious. I think they're going to pull back up to the 95 level with the rest of the market. Communication services is toast. As soon as we break this, which will be as early as today, we're going all the way down to the base. I would be shorting that sector. Technology, same thing, all the way back down to the base. Consumer staples, I think, are just going to have a little hiccup. Healthcare, maybe a little hiccup. Real estate is probably going to cool off and come down to the 36 level. Basic materials I like. We may go down to the 75-ish level. Consumer discretionary is toast. As far as the most vulnerability, communication services, consumer discretionary, real estate, and technology. The others are not that bad. They're going to survive, and I think this energy trout is going to go down just a little bit more before we hit the oversold territory. I got today. Now, today is Wednesday. On Wednesday, I usually give you my long idea and short idea. Today, I'm going to give you 2 longs and 2 shorts. First long, Uniprovident. This is an insurance company, health, casualty insurance company. Insurance companies are doing okay right now. They're not doing too bad, especially for large purchases. And if you see and look at what they do, you will see that this is a health accident insurance and health insurance, employee. Employees are actually picking up a little bit. They're not moving lower. Our employment rates are good, and the P/E ratio for the stock is good. It's not a bad performing stock, and it's cheap right now. And health overall is not doing that bad. I think the stock will stay around these levels. I don't think it's going to break this trend. And if it does, then I probably wouldn't want to buy the stock. But at these levels, there's a good chance it'll go above 43, or at least hold on to this downtrend while the rest of the market cools off. So I like UNM right now, and I think it'll go back up to the 45 level. Next one is Lamb Weston. Why do I like this stock? Well, it's a healthcare stock, but most importantly, it's not selling off. So this may be a good stock to buy near the bottoms and sell near the tops, but I like this for short-term swings, and I doubt it'll go much below the 50-day moving average. Even when it did, look, it stayed up pretty well. But with this downside, this is a good defensive stock. Now, to the downside, I think you've got some opportunities in two stocks in the next couple of days. Catalent, I think this stock is going to go all the way back to 40. It's already down 5% yesterday. If you look at the profile of this stock, healthcare pharmaceutical preparation, but they're not doing so well. This is not a company that's making a lot of money. They're down 60% this year. In the last 3 years, they're down 7%. Their PE ratio is no good. This stock is a dog. I think it's going to go down all the way to 40. And then Zebra. They say Zebra never changes its stripes. I think if this Zebra goes down to the 227 level, it may change its stripes. It's already down. It's a software company. It's an infotech company, as you can see right here. It's a leader in enterprise asset intelligence solutions with businesses, barcode printing. All of this tech stuff right now is not that great. In the last 3 years, the company gave us a 1.39% return. That's not that great in the last 3 years. It's not a very stable company, and I think right now with businesses on the sidelines, it's trading well below the 200-day moving average for a year already. I mean, look at this. Since January of this year, I think we're going to hit the 225 level or even break lower. So Zebra to sell, Catalent to sell, Provident to buy, and Lamb Weston to buy. Now, folks, if you're enjoying these videos, if you're getting value, if you're getting a little insight, if you're getting a heads up that the market's going to go up, down a week before it does, or 2 weeks before it does, like I've been telling you, like these videos, subscribe to these channel, give me some feedback on our videos on YouTube Wealth Press channel. And most importantly, folks, Chuck Hughes and I, we hosted a training yesterday revealing the details of the Champion Indicator. If you missed the event, click the link below to catch the broadcast right now. Now, I also strongly recommend that you watch it to understand how the indicator works, because we give several examples. Because if you like what you see, you'll get a list of tradable opportunities based on the Champion Indicator at 1 p.m. today. Chuck and Uncle Roger are going to give you their hit list. Oh yeah, it's like that. A high probability hit list too. But first, click on the link to watch the training if you missed it. Then I'll see you at 1 p.m. Eastern Time to get the list of stocks the indicator is flagging right now. It's happening at 1 p.m. Eastern Time. You don't want to miss out. Follow the link below, and I'll see you there. Comment below the video in the Wealth Press YouTube channel. Send me an email if you have any questions or concerns. support@marketgeeks.com. I think this market is going lower, and I've been saying the same now for a long time, and I haven't changed my tune. I'm not trying to get bearish here, but I'm being realistic. Bye, guys. Have a great day ahead.